Okay, think about this for a second. A company that back in 1965 paid literally zero corporate income tax. Fast forward to today, and that same company, it's the single largest corporate taxpayer in the entire U.S. We're talking an unprecedented $26.8 billion paid in 2024. And maybe even more remarkably, the person leading it openly talks about making mistakes. Welcome to the Deep Dive. Today, we are really getting into it, cutting through all the usual noise to explore one of the most anticipated releases in the financial world every year. That's the Berkshire Hathaway Inc. To the shareholders letter, the one from 2024. Now, this isn't just some dry report filled with numbers. It's really a window, a pretty profound one, into the mind of a truly legendary investor. And, the whole philosophy of an enterprise that's lasted and succeeded for so long. So our mission today is to pull out the most important nuggets, the surprising bits, and those core insights into what really makes for long-term success.
Exactly. We're going to try and peel back the layers here. It's a really comprehensive look at Berkshire's operations, their philosophy, how they see the future. But what makes it stand out, I think, is the wisdom you find beyond just the balance sheet. So yeah, let's dig in.
Okay, so diving into the letter itself, what jumps out almost immediately, even before you get deep into the financials, is this incredible commitment to transparency. Especially, like I mentioned, when it comes to admitting mistakes. The letter is really clear. A report to shareholders has to be more than just, the legally mandated stuff. It's about communicating what you, the shareholder, actually own, and crucially, how management thinks. As if, the roles were reversed.
Yeah, and they're really explicit about it. They actually say they owe shareholders additional commentary about what you own and how we think. And they want to communicate, basically, how they would want to be communicated with if they were the passive investor on the other side. This isn't just ticking a disclosure box. The deeper point here, I think, is that this kind of radical honesty, even about screw-ups, builds this incredible level of trust and, frankly, a kind of psychological safety that most companies just don't dare to cultivate. It really changes the whole meaning of accountability.
Right. And a huge part of that genuine partnership feel is owning up to failures. The letter's very candid about mistakes they've made in capital allocation, basically, where they put their money buying businesses or assets, and even mistakes in hiring managers. They even bring up Charlie Munger's old idea of thumb-sucking.
Ah, yes, the cardinal sin.
Exactly. That sin of indecisiveness or just delaying fixing something that's clearly wrong. Problems don't just vanish, they argue. You have to act even when it's uncomfortable.
It makes you wonder, though, how many other big companies openly use words like mistakes or errors? The letter points out Berkshire used those specific words 16 times just in their letters between 2019 and 2023. You compare that to so many other corporations that, as the letter puts it, rely on happy talk and pictures and actively avoid that kind of language. You've been on boards. What's your take on that stark difference? Does it ring true?
Oh, absolutely. It's a really powerful contrast they draw. I've definitely sat in rooms where mistake felt like a forbidden word. In board meetings, analyst calls, it created this weird pressure for perceived managerial perfection, which honestly always made me a bit nervous because it's just not realistic. But Berkshire seems to lean right into it. What do you think lets them do that? Is it just their structure or is there something deeper culturally?
It's definitely the culture. It's something they've built brick by brick over decades, and it seems designed to last. The letter actually makes a point of saying that Greg Abel, who's slated to be the next CEO, fully buys into this Berkshire creed of transparent reporting. He gets it. If you start trying to fool your shareholders, it's not long before you start fooling yourself, and that self-deception, that can be way more damaging in the long run than any mistake you admit publicly. It creates this powerful internal correction mechanism.
Yeah, that makes sense. And this whole philosophy, this transparency and willingness to embrace the unconventional, it clearly shows up in their results. And it absolutely extends to how they think about leadership and finding talent. The letter tells this story about Pete Legley of Forest River, the RV maker. It's just extraordinary. Pete apparently specifically wanted to sell his company only to Berkshire. He named his price, and then get this, he negotiated his own pay.
It was incredibly unconventional, wasn't it? He literally looked at Berkshire's proxy statement, saw what the top brass made, and said, basically, I don't want to make more than my boss. So he asked for just $100,000 a year, but then he added this kicker, a bonus of 10% of any earnings above what Forest River was already delivering. And the terms were famously vague. Things like appropriate adjustments for acquisitions, just trust. And the letter is blunt. Pete shot the lights out. No competitor even came close.
It's more than just a fun story, though. It really illustrates this core idea in the letter. how one single winning decision, whether it's buying a business like Geico, hiring a manager like Ajit Jain, or partnering with someone like Charlie Munger, can make a, quote, breathtaking difference over time. Mistakes, they argue, tend to fade, but the winners, they can just keep blossoming forever. It really challenges so much of modern HR, doesn't it? Maybe the takeaway is that the truly valuable talent isn't always trained, it's sort of discovered and then unleashed.
And what's really striking is their view on picking executives. The letter says, flat out, they never look at where a candidate went to school. You've got examples like Bill Gates prioritized getting going in a hot industry over finishing his degree. Pete Legal, described as just a natural. And then there's Ben Rosner, a retailing genius who apparently never went past 6th grade. The author, even though he acknowledges benefiting from great universities and believes in lifelong learning, makes this bold observation, quote, "A very large portion of business talent is innate, with nature swamping nurture." Now that's quite a statement. Do you think there are still areas where, formal training or continuous learning gives an edge even for these so-called naturals?
It's a fascinating point and definitely challenges convention. I don't think Berkshire is saying education is worthless, but maybe they're highlighting that certain core business talents, that intuition for value, decisiveness, and knack for spotting opportunity, are just deeply ingrained in some people. Education might refine those things, maybe accelerate them, sure, but maybe it can't create them out of thin air. It definitely makes you question assumptions about credentials versus just raw drive and intuition. The bigger picture seems to be that while education is valuable, real business acumen often comes down to this intrinsic talent for seeing opportunities, understanding people, making the call, regardless of the diploma.
Right. And this philosophy, this focus on transparency, finding unique talent, it clearly feeds into their financial performance.
Yeah.
So how did Berkshire actually do in 2024? The letter says it was a better year than they might have expected, which is kind of surprising, actually, given that 53%, more than half of their operating businesses, reported lower earnings.
Indeed. Two big things helped them out significantly. One was a big jump in investment income, mostly thanks to higher yields on Treasury bills. And the other was a major improvement in their insurance business. Geico, especially, had what the letter calls a spectacular turnaround under Todd Combs. Apparently, he's really reshaped the company, boosted efficiency, updated their underwriting.
And sticking with insurance for a moment, the letter touches on the climate issue. It notes that property-casualty insurance pricing got stronger, partly because of a major increase in damage from convective storms, think thunderstorms, hail, tornadoes. And then it says, very pointedly, climate change may have been announcing its arrival. That's quite a statement for them. They even warn that an inevitable, truly staggering insurance loss could happen basically any day now. Yeah, it underscores the huge risks in that PC property and casualty business, which, as the letter explains, is really Berkshire's core. See, unlike most companies that have costs before or during a sale, PC insurers get paid up front, but they only find out the true cost of what they sold much later. Sometimes, like with asbestos claims from 50 years ago, decades later, this creates what they call float, that pool of money they can invest. But it also hides these potentially massive long-tail risks.
Which explains exactly why Berkshire emphasizes what they call operating earnings. That was $47.4 billion in 2024, up quite a bit from $37.35 billion the year before. They focus on that instead of the standard GAAP earnings, because GAAP includes the ups and downs of their massive investment portfolio. But Berkshire's view is, look, our investment horizon's decades long, so those short-term market swings aren't really relevant to how the core businesses are performing day to day. They even explicitly say they disregard EBITDA earnings before interest, taxes, depreciation, and amortization, calling it a flawed favorite of Wall Street.
Right, and that just underscores their focus. Operating earnings, for them, represent the real economic engine. It's not muddied by market volatility or accounting choices. It's all about genuine, long-term value creation. And the letter breaks it down pretty clearly. You see earnings from insurance underwriting, insurance investment income, their railroad BNSF, Berkshire Hathaway Energy, and then all the other controlled and non-controlled businesses. That level of transparency about their internal performance metrics really highlights their commitment to giving shareholders the real picture.
Okay, now here's the transformation. It's just incredible to think about. 1965. That's the year the current management took over Berkshire Hathaway. Back then, it was a failing textile company, and it paid exactly $0 in income tax, not a dime. Now fast forward 60 years. That same company paid an unprecedented $26.8 billion in corporate income tax in 2024 alone. That works out to roughly 5% of all corporate income taxes paid in America, just staggering.
It really is an astonishing journey, and the letter points to one absolutely crucial reason why this was possible. Berkshire shareholders have received exactly one cash dividend in 60 years. Just one. A tiny payment, about $100,000 total, way back in 1967. So all those profits, year after year, decade after decade, were continuously reinvested back into the business. That's what allowed the company's taxable income to just balloon over time. Their total tax payments now exceed $101 billion. It's not just impressive for Berkshire, it's kind of a powerful case study for reinvestment and long-term compounding within the whole American economic system. That patient, reinvested capital, it fuels this extraordinary compounding growth that ultimately benefits the whole economy.
And just to give you a sense of that $26.8 billion figure, they use this vivid analogy in the letter. Imagine Berkshire sending the U.S. Treasury a check for $1 million every 20 minutes, around the clock, for the entire year of 2024, including the leap day. Even doing that, they still would have owed a hefty sum at the end of the year. You'd be well into January 2025 before they finally caught up.
It's a brilliant way to picture the scale, isn't it? And the letter connects this success directly back to what it calls the American miracle. It emphasizes how the sensible, better yet imaginative deployment of savings by citizens is what really fuels economic growth. It acknowledges capitalism has faults, absolutely, and abuses too, but it highlights its wonders unmatched by other economic systems, holding up America as Exhibit A.
So, okay, they have all this capital generated over decades. How do they actually put it to work? The letter describes their approach to equity stocks as ambidextrous, like using two hands. So on one hand, they control businesses. They own 189 subsidiaries, usually owning 80% to 100%. These are collectively valued at hundreds of billions. Owning them outright gives direct control, obviously, but it also means less flexibility if you make a mistake. It's harder to unwind.
Right. And then on the other hand, they own minority stakes, small percentages, but in very large, very profitable, often household name companies. Think Apple, American Express, Coca-Cola, Moody's, about a dozen or so like that. At the end of 2024, these holdings were worth $272 billion. Now, the crucial difference here is, while it's much easier to sell these shares if they change their mind, Berkshire has zero control over how these companies are managed or what they do with their capital. So it's the strategic balancing act, control versus flexibility in deploying capital.
And even though some people look at their cash pile and think they're hesitant, the letter really pushes back on that. It reiterates their strong preference for owning equities, good businesses. They state very clearly they will never prefer ownership of cash equivalent assets over the ownership of good businesses, and primarily American ones. They even talk about the risks of fiscal folly by governments and how paper money can lose value over time, emphasizing that relying on the success of businesses and your own skills is key.
Which brings us right back to why PC insurance is so central to Berkshire, touching on that float idea again. Berkshire's real edge isn't just having the float, it's how they manage it and the risks involved. Under Ajit Jain, their insurance operation has become a true world leader. It's known, the letter says, for its taste for risk and its Gibraltar-like financial strength. They can take huge hits, extreme losses financially and psychologically without flinching. And critically, they don't rely heavily on reinsurers, which gives them a material and enduring cost advantage. That float has grown massively, from $46 billion to $171 billion. Plus, I love this description of their managers, nervous but not paralyzed. That captures it perfectly. It suggests their competitive advantage comes from mastering complex finance and having this unique psychological resilience to handle the inherent uncertainty.
Now, while Berkshire is overwhelmingly focused on the U.S., the letter does detail one, quote, small but important exception, worth. And that's their growing investment in 5 major Japanese trading companies. They started buying shares back in 2019 in ITOCHU, Marubeni, Mitsubishi, Mitsui, and Sumitomo. Apparently, the initial attraction was simply how low their stock prices seemed relative to their financial track records.
Exactly. And since then, their appreciation for these companies has only increased. The letter praises how they deploy capital, their management style, their attitude towards investors. It even notes that the top bosses in these Japanese firms have far less aggressive pay packages than their American counterparts. Berkshire sees these as very long-term holdings. And interestingly, to manage currency risk, they've actually borrowed money in Japanese yen to largely offset the yen value of the stocks they own. Makes it currency neutral for them. It shows that for them, value investing isn't confined by borders. They'll look for sensible capital allocation anywhere. And right now, the math looks pretty good. The dividends they expect from these Japanese stocks in 2025 are around $812 million. Meanwhile, the annual interest cost on their yen borrowings is only about $135 million. So that's a nice positive spread.
Right. Okay, and finally, no discussion of the letter is complete without mentioning the annual meeting. It's become this huge event, almost a pilgrimage for shareholders. The letter gives a little preview of the Omaha experience. The goals for attendees are simple: get your questions answered, meet up with friends, enjoy Omaha. And of course, there's the huge exhibit hall selling all sorts of Berkshire products, everything from Squishmallows and Fruit of the Loom underwear to Brooks running shoes.
And there's something special this year. A new book for sale called 60 Years of Berkshire Hathaway. It was compiled by Carrie Silva. It's filled with photos, quotes, stories, featuring Charlie Munger quite a bit. But what's really great is that Carrie refused any payment for putting it together. And signed copies are being sold to benefit the Stevens Center, which helps homeless adults and children in Omaha. Plus, there's a matching donation. It's just a really nice example of that philanthropic spirit you often see connected with this kind of long-term success story.
It really is. And just a quick note on the meeting logistics, they're changing the Q&A format slightly this year. Greg Abel and Ajit Jain will be up there too, and Becky Quick will be handling the questions. But here's my favorite part, just a wonderfully personal, humorous touch right at the end of the letter. The author mentions his sister, Bertie, who's 91, will be at the meeting. And apparently she claims her cane is mainly to deter potential male admirers.
Yes. And he playfully throws down a challenge to attendees. Go observe Bertie at the meeting. He predicts she'll actually be surrounded by men. He even compares it to Scarlett O'Hara and her horde of male admirers in Gone with the Wind. It's just such a humanizing, funny little anecdote. It reminds you there are real people with personalities and families behind these giant corporations.
Wow. Okay. What a deep dive that was. We've covered a lot of ground here. From a company paying zero tax to being America's biggest corporate taxpayer, all while being radically transparent even about mistakes. We saw the impact of unconventional leadership, that strategic, long-term financial view, and these unique business models, especially in insurance, that fuel Berkshire's incredible success and, yes, its huge contribution to the U.S. economy.
It really does make you step back and think, doesn't it? Beyond just the impressive numbers or the clever business strategies, what this deep dive really seems to reveal is the maybe enduring power of things like humility, patience, and just sticking steadfastly to your core values. In leadership, in investing, especially over decades and decades.
So the question for you to ponder is, what does all this inspire in your own approach? Whether it's how you learn, how you manage, or how you invest. Definitely something to think about until our next deep dive.